Last week was a busy week in the stock markets. We saw a little drama as well towards the end of the week. We'll talk a little bit about that. It wasn't a busy week for the economic reports. We did see a couple key reports come out, but they're more important in setting up the economic report that's going to come out this week. That's going to be really dominant in the marketplace and everybody's going to be following. So we'll talk a little bit about that. We'll talk about what's happening in the earnings scene right now, as well as what sectors are winning, what sectors aren't, and we'll take a look at what should be coming up or what we can anticipate to come up in the markets coming shortly as well. To start off with, let's take a look at the economic report that probably had the biggest influence in the markets last week. This was the ISM Services PMI that came out last week. And if you can see here, first of all, this is the diffusion index. Here's the 50 level right here. And above 50 means that the services is expanding, and when it's below 50 down here, it means it's contracting part of the economy. What we've seen in the overall trend is we've seen this move lower and lower and lower. So the services has been growing at a lower rate over time, which is not good. Last week we saw the report come in at 50.1, which is barely expanding, versus an expected 51.5. So we're seeing this trend lower and lower than expected here, which means the economy probably is slowing down. If we compare that to the manufacturing sector, here's the manufacturing sector. The report here for manufacturing was released the previous week. Here you can see that we saw that drop after COVID, and we've seen a contraction in the manufacturing sector for quite some time. So the economy has really been relying on that services component, and that looks like it might be actually moving into contraction. This report was also released last week. This is the ISM Services prices paid. And if you take a look here, this is quite concerning. So we saw contraction in services, and this is what's happening to the prices paid. Look at the prices paid move higher and higher here. This is actually accelerating at a very fast pace. And you can see the line, purple line here, that's the expectations, and we saw that report come in much higher than expected. So the actual was 69.9 versus expected 66.5. So prices are moving higher and higher at a fast rate at this level. Now, prices paid is not the same as CPI, but there is an impact, and it is concerning that we're seeing this take place. There's a lot of talk about inflation right now. Is CPI high or low, et cetera, but this does not bode well for inflation when you're seeing the prices paid for services moving up like this. Last week we saw the retail traffic survey come in, and for North America, and it fell by 3.29%. Now we have seen this trend lower and lower over time here, which is not good. Now online is picking up some of that for sure, but still this is not a good trend. A lot of investors have been focusing on gold recently, and we saw on Thursday that there was a little bit of a concern because this article was published by the Financial Times that there was going to be tariffs placed on 1 kilo and 100 ounce bars, and we saw overnight the gold price shoot up and it really caused some dislocations. The next day, the White House came out and they clarified the situation and said that there was going to be no tariffs on gold bars towards the end of the day, which brought the price of gold down. But it was just some of the drama that keeps coming up here in the markets. Makes it a little bit interesting sometimes. Talking about drama, we had Trump on Friday appoint Stephen Murin, who's the current chairman of the Council of Economic Advisors. And he appointed him to serve on the FOMC board. So this is really interesting because he's come out with comments and papers saying that he believes that the US dollar should be lower and that tariffs are the right way to do things here. So definitely on side with Trump's philosophy. Now this is interesting because we could end up in a situation where he could be the next chairperson for the Federal Reserve, but there's still going to be one open spot when Powell retires or finishes his term in May of 2026. So there could be somebody else. So we're going to see two people competing for a position coming up. And that could get interesting because that could put them in a position where, you know, they're really trying to outdo each other just to get the job, which is probably not the best thing. So anyhow, an interesting drama situation again. And here's Stephen Murin's paper he put out in November 2024, right around the election time, I guess. Maybe he's thinking about getting a job, a guide to restructuring the global trading system. And tariffs are definitely involved. Okay, let's take a look at some of the action last week as far as the major sectors goes. Here's the S&P 500 up 2.4%. The winners were the growth sectors, consumer discretionary and technology. We saw that on risk on mode. Interesting that consumer staples was also one of the top performing sectors. Healthcare once again got pummeled. This sector just has been beaten up so badly. Energy was down again. And that's partly because there's more talk about peace with Russia and Ukraine. Which would be a good thing. And we did see energy respond down lower. Okay, let's look at some of the subsectors in the market here. Here's gold miners last week, 10.7%. Just started their strong seasonal period recently, doing really, really well here. It's interesting that gold did not do fantastic. It was still positive, but gold miners were higher, and we're seeing metals and mining also moving higher as well. Now that's partly because of the tariff situation. Also, we're just seeing investors try to look for another avenue outside of the technology stocks, and these sectors are benefiting. Uranium also had a strong week, not as strong as what we saw with the metals and mining though. I keep hearing from different investors saying, well, gold's moved up so much. It can't move up any higher, or it's different times it's oil's moved up too much. Commodities are different than stocks, and AI, Nvidia stocks, they're the exception. But a lot of investors will go, well, stocks moved up too much, therefore it's going to pull back. Commodities are different than that. They can keep going up and go up higher and higher, and they can keep going down lower and lower and lower. And so they tend to really get a lot of momentum for a bigger trend sometimes. And just because they moved up doesn't mean they can't move up higher. And I'm not saying that that's going to happen. Perhaps they move back here. But gold is in its strong seasonal period. It is in the consolidation phase. And it's at the upper end of that consolidation phase as well. But there really is this lack of interest in actually buying gold in the West. So lots of media attention because we're seeing the price of gold, but we're not seeing investors really participate in that. And if we take a look at this chart here, this chart is showing you the amount of ounces held inside the ETF in the States, GLD, the gold ETF GLD, so the big ETF. And you can see here we're going back to 2020 here. Here's 2022. You can see that the amount of ounces held, despite prices moving higher, but the amount of ounces held has been going down. So what's that telling us? That tells us that investors have been selling gold as prices have been moving higher. Now, it's changed a bit here in 2024 and 2025, but we're still not anywhere near where we were back a few years ago. And I'm pointing this out because we can see gold move higher, particularly if investors really start to get interested and buy gold as part of their portfolios, which really is not happening in a big way yet. So who is buying gold in their investment portfolios? Well, it's not the North Americans. More recently, it's the Chinese that have been buying gold. Now, I'm just looking at the ETFs. They're also buying on the retail market in a big, big way. But you can see here that we've seen recently in 2025 this spike of Chinese investors buying gold ETFs. So it's not North America. We're seeing it more from the East and other countries, by the way, even in Eastern Europe, buying gold. But if it starts to come back, the excitement comes back into North America, that could actually present a strong momentum picture for gold. I want to show this graph of XME. So this is the metals and mining sector that we took a look at earlier on. The performance, here's a relative performance. We've seen this upward trend, and this is still intact, which is still in this upward trend here. Now, typically we don't see the metals and mining sector perform well at this time of the year, and this is relative to the S&P 500. So we're seeing this strong performance from the sector. Now in the US, this is a small part of the overall market, okay, let's say compared to the technology sector, but this is a surprise to see this happen, and I believe partly it's investors are looking outside of the technology sector, as well as some of the effects from the tariffs, where you can see some of the companies actually having to focus their mining and production in the US. I also want to take a look at the technology sector. Here's XLK for the technology sector. Investors don't like it when I do this, but here's the trend for the technology sector. You can see here that we're having a breakdown, crossing that trend line here on an absolute basis, and we're seeing the same thing relative to the S&P 500. I don't know about you, but according to my eyes, I'm seeing this rollover taking place here on an absolute basis and relative to the S&P 500. Look, the technology sector has great long-term prospects, but technically we're starting to see this take place. And maybe it does start to correct higher here. But when you start to see this roll over here, that can mean we can see further weakness. Now, I think investors might be waiting for NVIDIA to release its earnings on the 27th of this month. They release their earnings later compared to the other technology companies. We've seen some strong earnings from the tech companies. NVIDIA has consistently beaten expectations over time. That's not very often. It comes in under expectations. So maybe investors have this false sense of security that, well, the technology sector is going to continue at least until NVIDIA releases its earnings. But I think investors should be paying attention to the relative strength for the technology sector. Had a strong week last week as well, but we are starting to see some rollover here, and we might see some more rotation out of technology, perhaps after NVIDIA, or maybe even before. This is the price of oil. We can see that it's actually been heading lower and lower and lower here recently. That's partly because there's more peace talks going on between Russia and Ukraine. So far, the Q2 earnings season has actually been pretty good. Here, you can take a look here. 80.3% of the companies have beaten their expectations. Now, that sounds really high. If you look at it over 10 years, perhaps about 73 or 74% of the companies beat their expectations. So this is better than normal, but the expectations is a real game where companies lower their expectations continually. Their announcements and the expectations get reduced. But nevertheless, the earnings have been fairly strong. This is a graph of year-over-year earnings here. You can see here that here we are for 2025 Q2. We have 13.2% growth. And you can see here that there's a base effect taking place, but we are expecting to see on at least a nominal basis earnings to go down here over time, but that's mainly because of the base effect. Just over a week ago, the expectation that the Federal Reserve was going to cut its federal funds rate in September was really a coin flip, about 50%. We've seen the expectation of a cut move up to 90%. At this level, it really almost ensures that there will be a cut in September here at this point. This is the key economic report coming out this week. This is the inflation report coming out. If you take a look for CPI year over year, we have the expectation for inflation to come in at 2.8%. Previously it was 2.7% last month. The services component is in this yellow shaded area. We were talking about services earlier, and the yellow area shows how big the services component is of that. Now, if we take a look here at how much inflation is, yes, it has come down, but do we know it's actually heading much lower from here? And there's all these arguments about that. A lot of people saying, well, inflation is dropping off fast, it's going to drop really fast. But I showed, the ISM paid services, the amount being paid going higher. So we just don't know. I don't blame Powell for hanging on here because we don't want to see another spike in inflation, because if that happens, that's really difficult to control. But a lot of people talk about, well, we're heading down towards 2%. We got to get ahead of that. And I understand monetary policy takes some time to have an effect. And I've talked about this repeatedly, 18 months to 2 years perhaps. But on the other hand, is 2% really the real target that we should be going for? Like, that's just a made up number, by the way. That was done a couple decades ago. They said, well, let's just choose 2% as far as the ideal target. Really? In theory, the best target is 0. But you don't want to go below 0 because then you get deflation and that causes real contraction in economic growth. So, I get there should be a buffer. Maybe it's 1%. So if we do go down even further than 2% for a while, that's not a big deal. I think we are still heading lower here, although I don't blame Powell for hanging on because we just haven't seen that definitive trend of it heading lower. Now, in certain countries, like China, we're seeing China really deflate at this point, and maybe that spreads to the world, but we just don't know. And that's the whole point here, because you really want to defeat inflation, because if it comes back, it gets really nasty the second time around. I want to finish up with this graph. Hat tip to Michael Kramer, who posted this. This shows the times where the S&P 500 on a weekly close has had a bearish engulfing candle. Really quickly, what that is in a previous week where you've had a positive week in the market, and then in the following week, you find that the open and close for the following week are engulf the previous week. In other words, they're higher and lower, and then it closes on the low. That's called a bearish engulfing candle, and that can sometimes reflect that the market is reversing at this point. And in this case here, we take a look. Michael Kramer's pointed out the times where we've seen that bearish engulfing candle take place, and you've seen the correction take place for the S&P 500 after that. So it doesn't work all the time, but it can indicate that we're seeing reversal in trend for the market. What I do find interesting is this is in 2024, right around this time of the year when the market tends to be weaker. We found that took place. And it also happened in 2023 as well from a seasonal perspective. The earnings season is slowly winding down here. There are still some big companies that are going to be reporting earnings, such as NVIDIA a little bit later on, but they're going to have less and less of an impact, except for maybe NVIDIA. And investors will be focusing more on economic reports. That's typically what they do. So we'll have to see what happens. I think the big report coming out this week is going to be the CPI report, and that's really going to have an impact on the market. And there's going to be a lot of interpretation for that, like what that means, and if inflation comes down much slower than expected, perhaps 2.5% or something, you can bet that Trump is going to be making some comments around that. So there probably will be some drama again this week. But past that report, we move into a period where we don't see a lot of big economic reports coming out to drive the market in the near term. So perhaps after we get past that report, we might see the markets settle down a bit. And I probably don't see a lot of upside room here, given that we are in the strong seasonal period. We're starting to see some technical patterns where we are seeing the market perhaps starting to weaken here a little bit as well. So yes, it can move higher, of course, but at this point, given we are in August, which tends to be one of the weaker months of the year, we're starting to see some more actually patterns that could indicate that the market could soften as well. So at this time, it's probably best to be cautious. Thank you very much for joining me today.